Hello and welcome. Thank you for joining us here at Pitt Capital Group to go over our webinar today, Surviving a Recession. We've got a lot of great data and information, thoughts from Dan and I to go over all the questions we've been receiving from clients and their client service teams. And also for people that use this as a resource, you're welcome to ask questions as the webinar goes on. We'll try to categorize them and time permitting answer as many as we can. If we don't address anything during the seminar and you still have a question, please do reach out to your client service team or follow up with us, and we'll give some more information on how to do that right there at the end of the webinar. Just a little bit about who we are and what we do and how we help clients. Pitt Capital Group's an investment management firm that's been using the fiduciary approach for over 25 years. We have that small feel, so the team of advisors and client service representatives that work with you can be a little bit more personalized and work to give you a much smaller feel, though we're a larger firm and helping many clients and businesses and institutions. Our webinars are also not just about financial planning and what's going on in the markets, but anything that could affect your financial life and your life as well. So we have upcoming webinars as well to help with lots of different topics, and they're all available on our website and our blog. I'm one of the financial planners here. Erica Meyer and myself service a team of clients, and happy to discuss with you any of the financial planning and investment planning that you need. Today's guest is Dan I. Dan's responsible for a lot of the investment strategies, all the investment strategies, and how we position ourselves for clients here at Pitt Capital. He also leads the investment management team and all the economic and market research that we do. We have some questions ahead of time, but like I mentioned, there are ways that you can expand the right side of your screen and find the handouts that we have, and also ask any questions. You might have to expand that to get that to open up, and we'll try to get to as many as we can today. So with that, let's get started. Dan, thanks for spending some time with us and sharing your thoughts. Let's start out just by talking about what a recession is. You hear a lot of different definitions of what a recession is. In your mind, describe what is a recession.
Sure. Thanks, David. And first, welcome to everybody. Thanks for spending some time with us today. I'd say the common definition of a recession is at least 2 consecutive quarters of economic declines or contractions in GDP. Each recession is different in terms of both severity and duration, but in general, I'd say some common characteristics would be a rising unemployment rate, slowing or contracting corporate profits, and generally declines in asset values like stocks and real estate. But again, each one is very different. Some have been extremely deep, long, and painful, and others we've already moved back into growth or expansion territory before a recession is even officially declared.
Okay, yeah, so a lot of people asking questions as things have been changing now, and at the beginning of the year, economic expectations among economists were firmly positive, and obviously the market has still declined. So what has changed?
Yeah, so my short answer would be a lot. A lot has changed in the market and the economy and on the geopolitical front as well over the last 6 months. But if I'd really highlight inflation and the Fed or the Federal Reserve as being the most significant or having the biggest impact on financial markets. We started off the year with, I'd say, fairly broad consensus expectations that inflationary pressures were mainly being driven by supply chain problems, and that would resolve themselves as the year progressed, and that inflation would decline throughout the year and wouldn't require the Federal Reserve to be extremely aggressive in raising interest rates. As we all know, inflation hasn't receded as anticipated. We're at more than 40-year highs on inflation right now. The situation's obviously been complicated by the war in Ukraine, which has caused a further spike in energy and broad commodity prices. We just had China, shut down a large part of their country, for several months due to their COVID policies, and that's obviously amplified and complicated supply chain issues. So the implications have been fairly widespread. Inflation is obviously pressuring consumers, the main driver of our economy. Their wages are not keeping up with price hikes. And it's also, forced the Fed's hand in terms of their path forward for raising interest rates. They no longer have the luxury of taking a slow and patient approach. They need to move aggressively to raise interest rates in order to bring inflation down. And I think it's probably helpful just to take a bit of a step back and talk about, the Fed's tools for combating inflation, because they're not, precision surgical tools. It's more of a blunt instrument designed to curb demand. And as the Fed raises interest rates, we see things like we're seeing now. Mortgage rates move from 3% to above 6%, and it cools the housing market. Interest rates on auto loans, credit cards, home equity lines, etc., rise, and again, curbs demand. Higher interest rates generally translate into tighter business conditions, which often means less hiring or layoffs at corporations. So we've all probably heard the debate about if the Fed will be able to engineer a soft landing, meaning can they really thread the needle and cool demand enough to win the inflation battle without putting the economy into a recession. And admittedly, that's not an easy proposition, especially given that the impact of interest rate hikes and monetary policy work on a lag. So you don't necessarily get the benefit of seeing in real time whether you've hiked interest rates too far, which certainly increases the risk of overdoing it. So we're seeing what markets do. They're pricing in the probability of different outcomes, pricing in the probability of that recessionary outcome. Excuse me, David.
And yeah, we've seen that market decline, and we've seen some of that price destruction. So have those recession fears been justified, or do you think that they're overblown with the market's reaction to them?
Yeah, so we wouldn't say that they've been overblown, but we don't think that a recession is a foregone conclusion either. First, recessions are part of the business cycle, right? So over a long-term historical context, they generally happen every 5 or 6 years. So I think a good way to think about it is that without any other information that you have, any random year, there's probably a 15 or 20% chance that you'll have a recession that year. If we had to put a probability on a recession in the next 12 months, we'd probably say something like 40 or 50% probability. But I think there are also a number of So I think, as I mentioned, recessions are part of the business cycle. We've had something like 17 recessions over the last 100 years. The stock market has made it through each one of those. Investors with a well-established investment plan has made it through each one of those, not without some pain. And I certainly don't want to discount that part, but long-term investors should absolutely expect to experience a recession through their investment time horizon is really the point here. Then the next chart shows U.S. GDP over the last 20 years, and I think the takeaway here is just how resilient our economy is. So when we do experience economic contractions or recessions, GDP doesn't plummet all the way back to the previous low points. We maintain a lot of the productivity gains and the technological advances that we picked up along the way. And it just doesn't take too long, for the economy to rebound right back in line with the long-term, trend growth rate. So again, a very resilient economy. It's never been a good bet to bet against the U.S. consumer or the U.S. economy. And I think a couple other points I want to make here. First, we look back at the last dozen recessions since World War II and the corresponding market declines. The median decline for the broad market was 24%. Obviously some shallower, some much deeper, but a median of 24%. 2 weeks ago, the market was down 24% for the year. So there's already been a lot of bad news, a lot of negative outcomes priced into markets, and we are seeing a lot of opportunities on our side as a result. So a lot of negativity in stocks already, but severe recession is not priced in. An outcome like 2008 and 2009, where there was real systemic risk in the banking or financial system, is not priced into markets. An outcome like early 2020, where our economy was frozen and 22 million people lost their jobs in a month, is not priced in. But we don't think that those should be, the baseline assumptions in terms of an outcome if we do see a recession. And we have that view for a number of reasons. First, our banks, the banking system is in great shape. It's not levered up 30 to 1 like it was before the financial crisis, or loaded up with toxic assets. Consumers are still in good shape, strong balance sheets, excess savings levels. Really the same could be said for large corporations in this country, strong balance sheets. And also the labor market is very tight. We could see a situation where the unemployment rate does rise a bit to cool demand, again back to the Fed's tools, and we'd still be not too far above long-term historical, what we would define as full employment. So if a recession is in the cards, we think those factors really help to mitigate the severity of a contraction.
Terrific. Yeah, a lot of things are different than the last time.
Right.
So I struggled to answer one of the next questions there, Dan, while you were gone. But we've had a lot of questions about should I go to cash and just investor psychology? Should I liquidate my portfolio till this is over? What will happen if I do? And what can you tell us about what to remind yourself of during market pullbacks and bear markets? Can you give us some thoughts here?
Yeah. So first answer is, no, you shouldn't liquidate your portfolio and go to cash. Those are always emotional decisions, and ones that have always been, the wrong ones throughout history, and the ones that have, very real, very significant long-term consequences to investors' goals and financial plans. This chart, I really like this because I think it helps to put those questions into context of investor psychology. If we look at this slide, I would say that we were in the thrill and euphoria phases back in the late summer and early fall. Everyone felt great about the market at all-time highs. Investors wanted to be involved in the latest, and greatest IPOs. Everyone was a Bitcoin genius and bull. And analysts were tripping over themselves trying to find ways to, justify valuations for unprofitable companies, margin loans. The list could go on and on. Things had gone right for so long that no one could imagine them going wrong. But these are the periods where risk is the highest. Investors have gotten complacent, valuations become stretched, and you get too many people on one side of the boat, and we all know what happens. Then we move down, the path to fear, panic, and eventually, capitulation at the bottom. Capitulation really being the point where, investors sell at any price to make the pain go away, to make the losses stop. They swear off investing forever, and they figure, I'll just have to make my financial future work with what I have left. And I think the biggest point is that this has always been the time where, the opportunities going forward are the greatest. So I think that if the go to cash question pops up into our clients' heads or to other investors' heads, I want them to at least, think about and remember this chart. And when when my team starts to hear questions like that frequently, we tend to think that, hey, we're probably getting closer to the end of the sell-off in the beginning, and it's probably time to start looking for those opportunities. And David, if you want to just maybe flip to the next chart, I think it really helps to, solidify the point that I'm trying to make here. So this chart's a little bit busy, but at a high level, it just looks at different levels of consumer sentiment readings over the last 50 years. And then, how well stocks have performed over the next 12 months, right? So I'll just walk through a couple of examples here. The first reading on the left of the chart is August of 1972. Consumer sentiment was very high. Consumers felt, really good. What did stocks do over the next 12 months? They declined 6%. We look back to February of 1975. Consumer sentiment was very low. What did stocks do the next 12 months? They went up 22%. So I'm not going to read every dot on the chart here, but the average return 12 months, after these extreme positive readings was a pretty low 4%. The average return 12 months after extreme negative readings have been, 25%. And you can see, if we look at the bottom right on the chart today, consumer sentiment is the lowest point in the 50-year period that we're showing here. And I'm not showing this chart to make or support any type of short-term market call. I'm just showing it to highlight how contrarian, markets are. So back to the should I go to cash question. Those decisions are always made in periods when bad things happen, when stock prices are low, when valuations are low, when investors feel horrible about the current environment, and everybody they know feels horrible about the current environment. And while they know they know selling into a panic and stress has been the wrong decision throughout history, they convince themselves that this time is different. And we don't think that this time is different. And our most important job is to make sure that our clients, don't make those big mistakes during periods of market volatility and stress. And
yeah, that can be difficult. And acknowledging that, there are times you say, hey, I'm a buy and hold investor and I'm going to be all right. But there was a Thursday or a Friday that was pretty difficult to stomach, and you think you're emotionally prepared for it until, you see it happen. It's difficult to stomach sometimes.
I agree, but I do want to touch on the final part of that question, because it's a really important part, and I don't want to skip over it. And that's what will happen if I do question. And I think if we turn the page here, David, I think the next slide really outlines, the typical outcome of that decision. So in this chart, we're looking at how different asset classes have performed on an annual basis or annualized basis over the last 20 years leading up to 2022. So if we look all the way over to the left, REITs or real estate related stocks were the best, up 11% a year. US stocks, strong returns, up 9.5%. And even if we look about the middle of the page, we see that, bonds were up over 4% a year over this 20-year period. And then you look at a proxy, in orange, a proxy for the average investor's portfolio and how it performed over this period. And it's pretty low, 3.6%, obviously well below stocks, well below bonds, which is, a bit difficult to wrap your head around, because pretty much everything on this page performed better than 3.6%. You would assume that the average investor's portfolio consists of a mix of these different asset classes. So the explanation is that, investors tend to buy stocks at the peak, while we're in these thrill and euphoria phases, and they tend to sell during the fear, panic, and capitulation. So the most frequent outcome to those go-to-cash decisions is growing portfolios at much lower rates than we've planned for, or that we've built our investment plans are around. So those have, as we all know, very real life consequences, which often means, scaling back on goals and objectives. And then one other point, and then I'll move on here, but I think the big important reason why it's impossible to time markets and why those that try usually shoot themselves in the foot is because markets are forward looking. While investors are still focused on all the bad stuff that is happening today and projecting the bad things that are going to happen into the future, markets are looking 6, 9, 12 months out. And markets always bottom, before all the bad stuff goes away. We saw that in the first quarter of 2020 with COVID and the lockdowns, where investors were in panic mode. So were politicians, policymakers, healthcare officials, everyone else. But the market looked through the situation and decided that this is something that the world is going to have to learn to live with it, and markets moved on much quicker than investors did. We look back to March of 2009, during the depths of the financial crisis, markets bottomed 3-4 years before banks stopped failing. Same thing with the savings and loan crisis, the 70s, and every other market bottom there's been. So again, just bottom line for me is I've never seen anyone abandon their investment strategy, have a well thought out and crafted strategy for getting back into markets. I've never seen anyone do it well. You're swapping one problem for the other. It's a much better, decision to think like a long-term investor and realize that volatility and declines are part of market cycles.
Thank you for that, Dan. Yeah, that was much more eloquent than what I said while you were gone. Okay, so the next question here. Do you still believe the Fed is only targeting a 200 basis point rise for the next year? What do you predict for 2023? For every 100 basis point increase this year and next, what additional percentage decline in the S&P 500 would you forecast?
Great. Yeah, so a lot to unpack there. So let me take these one by one. And first, there's no magic formula for 100 basis points of interest rate hikes equals X declines in the S&P. Markets are constantly adapting and pricing in expectations for Fed policy and interest rate hikes. For example, markets already understand that the Fed's going to hike interest rates in July. It's not as if that will be new information to the market when the Fed makes their decision on July 27th. So in fact, the Fed has already told us that they project that they will have interest rates at short-term interest rates at 3.4% at the end of the year, and they will end their hiking cycle at some point in early 2023 at 3.8%. So that's obviously a big adjustment from the zero interest rate policy that we've lived with for the last 2 years. And I'd say the market declines this year, has been the outcome of that transition process away from zero rates. But going forward, the market's really going to be searching for clues, if the Fed really needs to raise interest rates in line with those pretty aggressive projections, or will they be able to be more patient and more flexible? And inflation is really going to be the key, determinant to that equation. I like the question about 2023. We're not going to make any formal predictions about the year at this point, but it's a good question. So back at our client events in January and February of this year, we said that we expected 2022 to be a reset year, and be a reset year after 3 phenomenal years of returns for the markets, and that we needed some time to recalibrate and normalize in a number of different areas. And that's where I get a bit encouraged about how things could look for next year, right? So interest rates have normalized to a large degree. The 10-year government bond yield is at more than a decade high. We've certainly cleared a lot of this speculative froth that we've built up in markets back in, again, the summer and the fall. And valuations have gotten a lot better. The broad market went from trading at about a 30% premium to long-term historical averages at the beginning of the year. Now we're right down to long-term averages, 10, 25-year averages. So I guess my point is we've seen those resets in a lot of areas, and while the Fed may have some more work to do in terms of raising interest rates in the near term, they could very well be done their process by early 2023. And if history is any guide, the Fed has started to cut interest rates very quickly after they wrap up their hiking cycle, and that's exactly what markets are starting to price in. So stay tuned, but I think we could be in a situation in 2023 where the adjustments that needed to be made, have been made, and where we're back to, the Fed cutting interest rates. And as we all know, markets love that backdrop. And if that's the outcome, and the Fed has been successful in taking interest rates back up to their target levels, they're going to have a decent amount of ammunition, going forward in terms of, rate cuts to spur an economy.
Okay, thank you for that, Dan. Actually, I was listening to your response there. One question did come in. It's similar to that that notion of what the Fed doing. Is it working? So the question is, steel, copper, and fertilizer are all off their highs from March. Is this a breather or a peak in commodities? So I mean, is that evidence that 75 basis point cut working?
Yeah, we've seen, the industrial metals index enter bear market territory. We've seen, shipping rates from from China to the U.S. fall by about 35%. We've also seen big retailers like Walmart and Target tell us that they have too much inventory and they're going to need to start discounting going forward, which is certainly not inflationary. And instead of listening to economists or forming a pundits or a view, if we look at the fixed income markets have a good way of telling us what they expect inflation to be over the next 5 years, and those levels have dropped pretty dramatically from the end of March to where we are today. So I do think we're seeing some encouraging signs that the inflationary pressures are starting to fade. It hasn't shown up in the official inflation data yet. We think it will, but admittedly, energy prices are still a problem, and one that'll probably be more difficult to figure out in the near term.
Okay, so yeah, can you discuss how the recession could affect the manufacturing sector?
Yeah, sure. So in a recession, demand contracts, and so do areas such as industrial production, which negatively impacts the manufacturing sector. But not all manufacturing or industrial businesses are the same. We have exposure to industrial companies that have huge backlogs that they need to complete and turn into actual profits, even without generating new sales. And a lot of industrial companies also have very long established track records of cost-cutting initiatives and efficiencies in the middle of recessions that turns into very attractive profit margins when the economy does turn. And also, I would describe most of our industrial exposure as long cycle businesses, where it's difficult for customers to just cut off production or cancel orders because they expect the economy to be weak over the next couple of months. So I think a good example of that would be the commercial aerospace space. If an airline company knows that they need hundreds of new planes over the next decade, again, they don't have the luxury of pausing orders for a quarter or two. I think defense companies would be another good example, which generate a significant portion of their revenue from the U.S. defense budget, which is $800+ billion and not likely to decline anytime in the near term. they probably aren't going to see a massive interruption in their order. So sure, manufacturing activity generally declines during a recession, but it's also a time where efficiencies are gained, and those long cycle industrial businesses tend to hold up much better.
Thank you. So next question coming in here. I encourage my daughters to put money from the sale of one house to be used for a purchase of another house in a couple of years into the market instead. What should they do now? So it seems like, hey, a couple of year time frame, short time frame, do you favor the real estate market for the next couple of years or the stock market where we are?
Yeah, well, I think it seems to me that that's a question of kind of making a bet on where markets are going to be in 2 years. So I'd view 2 years as too short of a time frame for long duration assets like stocks, and that's a statement I would make in the market environment where stocks are doing well or stocks are doing poorly. When you have a long-term time horizon and you're making contributions to your portfolio, you don't have to react and sell into a down market or a bear market. When you have a well-constructed portfolio with cash and bonds to cover cash flow needs while markets recover, again, you're not forced to sell into a bear market or a big downturn. But if you've made a short-term bet, and I would call 2 years a short-term bet, that stock prices will be higher 2 years into the future, and that's not the outcome, you could certainly be forced to sell stocks at a very opportune time. So I would say a combination of money market funds, treasury bonds, high quality short-term corporate bonds would probably be a more appropriate solution for that type of time horizon.
Okay. And next question, you did touch on the I bonds there, but we've been receiving a lot of those, as some pundits have pointed those out. But what are our views on I bonds and gold in the current environment? Can you give us some thoughts there? I'll jump in real quick and answer on the I bonds. We do get a lot of requests for those for the clients. Right now it is 9%. You can do $10,000. It's not something that we can do for you or you can do on your own through a Fidelity or Schwab or TD Ameritrade account. You actually have to go to Treasury Direct and set up an account to do that on your own. You can do that on your own, or you can, if you're lucky enough to have a tax refund, you can direct it into that account whenever you do get a rebate on your taxes. But Dan, what do you think about I bonds and gold right now?
Sure. So I'll tackle gold first, and I've never had a really strong, pound the table investment view or opinion about gold. If someone wanted to, hold a few percentage points of their portfolio in gold, I probably wouldn't, again, pound the table against it. It's done well in periods of extreme market stress, but we do have a very strong preference for investing in businesses instead of unproductive assets like gold or cryptocurrencies, or you could add to that list. Gold doesn't produce cash flows, gold doesn't pay dividends, gold doesn't have an earning stream that it can grow over time. So I would look at a company like Apple, just to pick a name out of the hat, a very widely held stock. The stock's up more than 600% over the last 10 years, and that's not because of random chance or good luck. That's because 10 years ago, Apple earned $1.40 a share for every share they had outstanding, and this year they're expected to earn more than $6 per share. So the value of that business has increased dramatically because the earnings power of that business has increased dramatically, and that's really what we're looking for. Companies that'll be able to grow their earnings, to grow their dividends. Gold can't do that, neither can commodities or bonds or cryptocurrencies or other unproductive assets. So again, strong preference for investing in profitable businesses. On the I bond front, I think you covered the part about you really can't invest a ton of capital into these. I would say the other issue is you can't lock in that 9% return for any long period of time. If you could, I'd say go for it. But I think there's a number of things to remember. The interest rate that these I bonds pay you is linked to inflation, and it's adjusted or reset every 6 months. So as inflation falls from peak levels, so will the interest rate on these I bonds. And these are 30-year bonds, and you can't redeem them without penalty for, I believe it's 5 years. So the question is really, let's say over the next 5 years, does the most likely declining interest rate payments from the I bond result in better yields than you could lock in today? And we're buying high quality 5-year corporate bonds today at 4.5%, 5% yields that again are locked in and can't be reset lower. So just in real basic terms, I'd say if you think that inflation is going to average more than 4.5% or 5% over the next 5 years, I bonds are probably a pretty good way to express that view. I don't think that'll be the case. Again, the fixed income markets are telling us that it doesn't believe that will be the case either. So I would prefer fixed income options where I think investors can earn more attractive average returns over an investment time period like 5 years.
Terrific. Thank you for that insight. And one question that came in a little earlier while we were talking, and it's on fixed income, so just to stay here. So would you consider bonds having a positive correlation to equities today? In the past, they were negatively correlated.
Yeah, I think that's a really good point, and we have seen a strong correlation between the price of the stock prices and bond prices. So when bonds sell off and interest rates rise, stocks have sold off this year. And I think it really points to what we need to see for a durable bottom in equity markets, and that's investors getting comfortable with the view, or kind of seeing the whites of their eyes in that inflation has peaked. And when we see inflation peak and we see inflation levels start to fade, I think that's when you can see bond yields stop rising, and that correlation between stocks and bonds should decline.
Terrific. Thank you for that. Next question, are you bought into ASML and semiconductor chip manufacturers, home health companies, and defense companies? I see that these areas are doing great even with the terrible market. Are there sectors, industries you're constructive on now, Dan?
Yeah, so I would agree with most of that. We don't own ASML specifically, but we do own a number of semiconductor companies, and we think that it's just a great way to invest in greater and greater connectivity and major growth trends in areas like data centers and networking and telecom and connected vehicles. The list probably goes on and on. But we do have a strong preference for the semiconductor companies that actually outsource the manufacturing of the chips and instead focus more on the technology and the design, which tends to lead towards better profitability and better cash flow. But we definitely agree with the broad view that the semiconductor space is attractive. We really like healthcare in general. I think especially large cap pharmaceutical companies that generate just tons of cash flow, pay very strong dividends, have good balance sheets, and decent earnings growth profile. And those have held up really well in today's current environment. We don't have exposure to home healthcare companies. I think those businesses, they generally have very low barriers to entry, making it really easy for new competitors to step into the space, which translates into more competition and hard to earn really attractive margins. And then finally, defense. We do like defense company stocks. The sector again has held up really well this year. Again, it's levered to the U.S. defense budget, which isn't going down in the near future. We're also seeing European and NATO countries really get serious about meeting their defense spending pledges. I think Germany was a really good example of this, which Germany just came out a little while ago and said we're going to be spending an extra $100 billion over the next 2 years on defense. So I've always viewed the sector as, a really good way to hedge against an unstable world, and we've certainly seen a lot of that in 2022.
Terrific, thank you. And next question here. So this one, what percentage has your overall portfolio decreased since its high? That one's a little bit of a tough one. We operate many different strategies here at Fort Pitt Capital with different asset allocations. So it's difficult to give one number that encompasses all that. But Dan, how would you talk about how we've done just peak to trough since this market decline?
Yeah, again, I don't want to duck the question, but I think it's one that really requires a client-specific or nuanced answer. As you mentioned, David, we manage 7 different strategies, and our clients have different levels of equity exposure or mix between stocks and bonds depending on their own unique circumstances and goals. I will say that it's we've seen a pretty significant, I think it's important to mention, we've seen a pretty significant divergence between returns of growth stocks this year, which are down about 25-26% at the index level, and then value stocks, which are down 12 or 13% and have held up much better this year than growth. So the growth stocks are the ones that are more exposed to the outcomes that we've seen this year, and outcomes we haven't seen in a very long time, like rising interest rates and elevated inflation levels. A lot of these growth stocks are valued not based on what investors think that they're going to earn this year or next year, but their valuation is really heavily tied to what these companies are going to earn 10 years out into the future. And with an inflation at 8+%, those earnings a decade out are worth less to us today. So I'd say our strategies that are more focused on value have certainly held up much better. Those that have a heavier weighting to growth have suffered more this year. I'd probably put an asterisk by that growth has outperformed for the most part, outperformed for the last 10 or 12 years. So we're seeing 6 months of outperformance for value here. I think that's important to mention. And I would also say, I think our fixed income portfolios are also holding up really well in a very rough environment for fixed income. One of the worst return environments for fixed income that the world has ever seen. So our short duration stance or having exposure to more short maturity bonds has certainly been really beneficial in a world where interest rates have risen very aggressively in a short period of time. So if it's a client that's asking that question, your advisor can get you the specific answer for your portfolio in about 20 seconds. If it's a prospective client that's asking the question, we'd be happy to share, long-term performance data on our strategies or the combination of the strategies that we think would, be best suited for your specific situation.
Terrific. Yeah, and similar came in while we were discussing that. What should retired people with only a 15 or 10-year time horizon be considering for an investment strategy for retirement income? And to your point, I mean, that's what we work on every day, myself and Dan and the investment management team's focused on the market and the investments, but we have a group of planners here that we dig into those cases, and it'll depend on how your assets are structured, how much is qualified versus non-qualified. We're basically going to use all the things that Dan just touched on. We're going to use growth stocks and value stocks and fixed income. We're going to cobble together a couple of different strategies to make sure we can get you to where you need to go for your income. So same thing, we would invite you to reach out to us to get some, so we can listen to a little bit more about your specific situation, and then ask the right questions to make sure we're putting together the right recommendation and plan for you. Next question, do you think or how do you make the decision to stock up on resources?
Yeah, so maybe I'm interpreting the question the wrong way. I'm going to assume it is, how do we decide to buy or not to buy, resource stocks, or maybe stock in companies that produce commodities. If I get that wrong, feel free to reach out and we'll get you a better answer. But in general, I'd say I'm not a huge fan of investing in companies that are highly leveraged to commodity prices. Commodity prices are outside of management's control. They're impossible to predict, and as we've seen recently, they're kind of subject to these boom and bust cycles. And I think oil prices are a great example. I think back to not very long ago, April of last year, oil prices cratered to something like negative, that's right, negative $30 a barrel due to oversupply. And here we are today, and just recently, oil prices hit a high of $124 a barrel. So 14 or 15 months ago, investors are worried about energy companies being able to survive in a backdrop of negative prices, and here we are today, and oil companies are being threatened with windfall taxes by politicians. So we do have some energy exposure, we do have some exposure to energy infrastructure companies, but a stronger preference for businesses where profitability is more driven by superior product or service. Profitability is more in control of management, or management has more control of outcomes, versus companies that again are just highly levered to commodity prices.
Thank you. Next question. Is it time to consider taking traditional IRA balances and converting them to a Roth? So one of the takeaways that I've had from what you've said so far, Dan, is going back to when you talked about how markets tend to bottom before the end of the recession. We can't wait for the official recession is over flag to pop up before the markets start to turn around. So it's hard to know where that bottom is. But if you believe in the companies and the investments that we're talking about, and I do, those companies that are paying dividends and doing the right thing, and on the same side as shareholders that have taken a hit in value, if we're going to continue to hold them, it does sometimes make sense to pay some taxes and move that over to a Roth IRA, so that when the rebound comes, that is going to grow, and now we've got it in the Roth IRA. One thing I would say, even though that could be a good move with this potential market decline, we would again invite you to call us and welcome you to go over your situation with a little bit more specifics. We actually do give that type of advice to people and give them specific dollar amounts. You do have to be careful. Sometimes if you convert too much to a Roth IRA, taxes on your Social Securities can go up. Your Medicare premiums can go up if you have too much income. So we want to make sure that we convert the right amount, right? So it can be a great thing to do when the market's declining like this for a long-term investor, but we want to check your personal situation and make sure that you don't overdo it or become overzealous with the amount you convert and then run into some other problems. But what do you think, Dan? Is now a good time to convert to a Roth IRA?
I think you hit all the important points, David. Absolutely.
So one more question came through that we have time for. So we are a go anywhere total return investment manager, so we can go to international markets when we choose. But would Fort Pitt Capital recommend investing in euro-denominated equities with euro-US dollar near parity?
Yeah, I won't take a big, a big stance on the euro versus the dollar. But what I will say is that we've had a very significant overweight to U.S. equities for a long period of time, and we've seen a dramatic outperformance from U.S. equities over Europe and other areas like Japan, again, for a very long time. And I don't think it's just random chance that's happened. I think you compare U.S. businesses versus Europe, and what you see is that U.S. businesses are more profitable, they're more efficient. I don't see any real catalyst to change that in the near term. And I think also when you look at the composition of those two markets, even at the index level, you see that the U.S. has the S&P, for example, has something. Let's call it 25% of our market is in technology stocks or companies. It's only about 6% for Europe. So I think the way that Europe outperforms the U.S. for the long term is that technology stocks just continue to outperform, or I'm sorry, technology stocks continue to underperform. That's not our view for the long term. So no change in our view, I would say, on having a strong preference for U.S. companies, especially given that, again, you look at a proxy for the U.S. markets like the S&P, and we already generate 35 or 40% of our revenue from outside of our borders. So you get plenty of international exposure, even with a heavily domestic focused portfolio.
Bank, and though we have a heavily domestic, there are times that international names are added when the value arises, correct? Okay. So Dan, thanks for sharing so many of your great thoughts today. I think I've learned a lot, and there's been a lot of great information. But to summarize, what are some of the green shoots that you see, or some of the bright spots, even with where we are and a lot of the things going on? Where do you see some opportunities, or what are some of the things that give you some encouragement in where we are in the market today?
Yeah, so I kind of compare where we are today versus the beginning of the year, and again, I think it's a positive. It hasn't been without pain, hasn't felt great, but I think we have made a number of the resets, the adjustments that we needed to make. Interest rates again have normalized. Valuations have reset to a large degree, and we do see a lot of, let's forget the index level, a lot of businesses out there that are trading at very attractive valuations if we use a 3-5 year time horizon. So I think we're seeing much more in terms of opportunities today than we were back at the end of 2021 or 2022, or the beginning of 2022.
That's terrific. Yeah, so I think that is encouraging as well. Some of these things have declined enough where the risk reward does pay off pretty nice if you can be in there for 3 to 5 years. So absolutely terrific. Thank you, Dan, for sharing everything with us today. And just to plug some of the upcoming seminars that we have coming up, on July 21st, David Graver is going to go over cash balance plans and how business owners can use them. And Skylar Riddle on August 25th will be doing elder care planning. Will be the topic, so some good topics coming up. And then this seminar and webinar will be available on our blog, as will those ones as well. If we didn't get your question right, we appreciate you taking the time. But if we didn't get the context right, please do reach out to us. We've got my email address and number here. Happy to talk a little bit more, and we can ask some more questions to hopefully put together the right recommendation for what you are looking for. And a compliance slide here, just to make sure we're fully in compliance here. But appreciate everybody attending, and be safe out there. If there's anything we can do to help, you're welcome to reach out, and we're happy to do what we can for you. Thank you for attending.